seen a huge amount of first home buyers in the marketplace. And I think there was a real rush to try and get into the market. They could see the market rearing away from them and they were just desperate to get in and really keen to try and secure something.
Those that instead of buying their first home are buying their first investment property. So are you seeing many of them? And for someone that is just starting out in investment, what do you think are some of those important factors to consider for their first loan? Is there any sort of mistakes you see first-time investors make when it comes to their loans or their financing?
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
We've got a few interesting topics to dive into today, which I think will help people on their whole real estate investment journeys, from starting out investors to then leveraging a bit of that equity that many of our clients will find that they have. Many probably don't even realize they have so much at the moment, which is a nice thing.
Yeah, it's been a long time coming. So it's been fantastic to see the Perth market create those opportunities for people, for sure.
And then we can sort of chat a bit further about, going beyond some of the big banks and possibly opening up some other options to people that might think that they couldn't add another property, but potentially can through alternatives as well. So got a lot to talk about.
For sure. Look forward to it.
So give us a bit of background as to what you're seeing at the moment, and what are the sort of different clients you're dealing with?
Yeah, so we're seeing over the last couple of years, we've seen a huge amount of first home buyers in the marketplace. And I think there was a real rush to try and get into the market. They could see the market rearing away from them and they were just desperate to get in and really keen to try and secure something. We're now seeing, I think, a slightly more mature market, in as much as we're seeing people looking at that equity you're talking about before and looking at seeing what options they've got. So now we're talking to clients and seeing clients wanting to upgrade the family home, where they might have seen their entry-level home gain some significant equity. And now the step to get into a more aspirational suburb, into a better area, better property, is not as big a step as it seemed to be before. They've got more equity to play with. So we're helping clients do that. And we are seeing investors looking to take advantage of the equity they've got and seeing what options they've got and that sort of thing. Yeah, so we're seeing a bit more across the board now.
Yeah, so interesting as the cycle goes, the types of people that are more active seems to be changing. And are you seeing many local investors, or are they East Coast investors, or your client base is probably mainly local in any case?
Yeah, we do have clients around the country. Most of those, I suppose most of the business we get is word of mouth. So the clients we've got that are over east have either started here and ended up over east, or they're relatives of people from Perth. Mm-hmm. So we are seeing some of that, and we are seeing some of those clients on the East Coast in the early days were buying in WA, and we're now seeing some WA clients who are buying in Perth. And prior to that, we've seen WA clients buying over east as well. So, but there are definitely some Perth people looking for property in the Perth market at the moment, for sure, for investment properties. Yeah.
One of the interesting outcomes from one of the last episodes I recorded was CoreLogic finding a bit of an uptick in first-time investors. So those that instead of buying their first home are buying their first investment property. So are you seeing many of them? And for someone that is just starting out in investment, what do you think are some of those important factors to consider for their first loan?
Yeah, well, I think we are seeing a bit of that rest invest, where we're seeing first home buyers who perhaps can't afford to purchase in the area where they want to live, which is maybe close to the city or handy to work, or those lifestyle areas. So they may be able to afford to buy a particular property in those areas, but they sort of think, I wouldn't mind getting some a bit more land holding, a bit bigger for later on in life. So we've had a number of those where we've had clients that have come in. So pretend really they're first home buyers, but they're buying their first property as an investment property. So they're first up investors, but also first time property purchasers. And then the second group we're seeing is people that have had a home for a while and have built equity in that home and are now looking to say, okay, we're happy where we live. We want to take advantage and explore this thing called property investing and look to buy our first property investment. So I think if your question is what should people look out for and what should they do when they're looking for finance, I think you've got to start early these days. It's complex, so you've got to get all your ducks in a row. Certainly in this market, you can't buy unless you've got your finances sorted. So I think it's about having that idea that you want to buy something. It's about getting the help, which property to buy, that sort of thing. And from a financing side, sitting down with a broker or whoever you speak to about your finance to make sure you get everything lined up in relation to that. So it may be getting rid of some small consumer debt, for example. Might be clearing out some old afterpays. Afterpay is always an interesting one where you might have bought a TV years and years ago, paid it off, yet the facility remains there. So maybe having a look at your credit file just to see how that goes. So just getting all those little things in place. Remembering that lenders and bankers tend to look at your expenses as well. So if you are looking to borrow, particularly if you're pushing to borrow, towards your maximum, making sure that your living expenses are not over the top. So looking at that and then sitting down, actually seeing what you do qualify for. So you know what your budget is and what you can purchase them up to. Investment properties are different because some of the things you want to look at with investment property is what the holding costs on that property are going to be. And you need to be factoring that into your budget, and also what the rental return could potentially be and the condition of the property, to be able to get it to a position where you can rent it out, are you going to need to spend money on that in repairs and maintenance or refurbishment before it's going to attract the right tenant? So I think it's very much, you need to be working with your property professional to help you get a lot of that information, plus your finance people together. Yeah.
And is there any sort of mistakes you see first-time investors make when it comes to their loans or their financing?
Yeah, I think buying an investment property, the structure of your loan is very important. The loan type is very important. So, for example, if you have an existing home and you're buying an investment property, it is often advisable to have those securities, what we call standalone. So rather than just linking your existing or your new investment property off the equity you've got in your existing home, rather than doing that and having both those properties securing both loans, that what you actually end up is you take 3 loans. So your home secures your home loan plus a deposit for the investment property, and then you get a separate investment property loan that's secured just by the investment property. And there's reasons for that can affect you down the track with wanting to do your next stage, or if you want to sell a property and get some cash out. So it can have really big ramifications for that. So I think about having a conversation about that, understanding that and making an educated decision about what is the best structure for yourself is important. The other thing is in relation to the actual loan structure. So often when people buy a property, their first home, they may look at paying extra into that home loan and building equity. With investment loans, often we will look to use offset accounts and things like that rather than paying down the debt. And there's a whole range of reasons for that. But that's a conversation I think you want to have and look at that and see if using an offset account, so you're retaining your cash so you can use that for your next adventure whilst maintaining the tax-deductible debt. It's very important to understand the difference between non-tax-deductible debt and tax-deductible debt, and preserving that tax-deductible debt so you've got cash to use in your own personal purposes. Yeah.
And
so I think,
where do you sort of find, when you're starting out, it's pretty hard to scrape together all the possible, purchase costs. You've got your deposit, you've got your other purchase costs with transfer duty, you've got a buyer's agent cost to pay, settlement agent cost to pay. So it sort of adds up. So what sort of loan to value ratio do they typically look at, and so when you're trying to scrape together a deposit, you've got all those extra costs to pay as well with transfer duty and settlement agent, and you've also potentially got a buyer's agent cost to pay. What sort of loan to value ratio are you finding first time investors are getting? And, what else do they need to be aware of if they are pushing things higher in the loan amount that they're borrowing?
Yeah, well, I suppose with most borrowing, depending on your profession, but for most people, 80% is the cutoff if you don't want to pay lenders mortgage insurance.
What professions can borrow higher? Because I am doing strategic plans for a few very select professions, and they're almost they almost need to take advantage of that as long as they feel comfortable borrowing at that higher percent. If they don't have to pay LMI, it's a real advantage.
Yeah. So a lot of the medical professions. And then there's some other degrees which some lenders will look at as well. So things like engineers, that sort of thing. So yeah, it's sort of case by case. But I suppose if anybody's got a profession, it's a question they should always ask, can I get a lender's mortgage insurance waiver? And then some lenders will consider it for investment properties, some won't. So it just depends, right?
Yeah.
But it's a question to ask and it's something to be mindful of. So if you borrow more than 80%, you're up to lender's mortgage insurance. The lender's mortgage insurance premium can vary significantly depending on the size of your deposit. Ideally, what we try and do is keep the loan to value ratio no more than 90% of the purchase price. And that 90% includes all the costs that are potentially part of the loan, including the lender's mortgage insurance. Often between 80 and 90%, the interest rate is slightly higher than 80%, and between 90 and 95%, which is the maximum you can go to with some lenders, 95%, the rate is higher again. So that sort of below 90, between 80 and 90, is the preferred range if you're doing lender's mortgage insurance. But again, it depends, and it depends a lot. You know, if the market, like we've seen recently, is having significant growth quickly, well, then it's a question about getting into the market sooner rather than later. So you would have been better off, in hindsight, getting into the market, paying lender's mortgage insurance, because the growth you would have seen in that property would be significantly more than what the lender's mortgage insurance premium is. And now those clients that were a 90 or 95% loan 2 or 3 years ago are now sub 80, and we can refinance them out at a lower rate. So some of it depends on where you think the market's going and all that. Yeah.
Yeah. And as you just mentioned, then you can wrap or include the lender's mortgage insurance in the loan if you're still sort of under that threshold. So you might not have to come up with that in cash per se.
That's right. So let's say you had a loan to value ratio 87% and the lender's mortgage insurance premium was 3%. That takes you to about 90, and that would get added onto the loan. The furthest you can go is about 95%, including all those costs. But at 95%, the premium, rather than being 3%, might be 4%. So it just depends.
Yeah.
So again,
it's worth looking at your savings rate and seeing how quick you might be able to save yourself into another bracket versus how quick the market's moving, and sort of, see.
Yeah. And it's hard. You can't get a sort of I can't give you an exact percentage because everything always changes, So I think what the thing is, when you're thinking about this is what you want to do, you sort of want to sit down with your broker or your lender and say, okay, if I was to buy something for this much, what would it be? This much. And we can sort of do different scenarios, working out what the lender's mortgage insurance premium would be and showing what the whole cost of that would be. If you're using equity in your existing home, it's important to get that figure right as well. So obviously these days we've got the online tools and that sort of stuff. But if we're seriously looking at proceeding, well, then we probably need to get a bank valuation on that property as well, knowing exactly how much equity you do have.
Yeah, you don't want spanners coming into the works later.
Best laid plans. That's right.
So now, is it still important to get a pre-approval, do you think? And what are the other sort of options other than the formal sort of pre-approval for people?
Yeah, so I mean, a lot of the lenders have sort of gone off pre-approvals a bit because they are a lot of work, and the actual strike rate of the number of pre-approvals some of the lenders were telling me to actual becoming deals was very, very low. So, but some lenders still are doing pre-approvals. With us, what we tend to do is get the information that a lender would normally need to do a full approval. So we'll do credit checks, we'll check savings, expenses, income, all that sort of stuff, and see if they qualify, for a lot of different lenders. And if it's very, very conservative, what we might do is offer to issue what's called a letter of eligibility, which the broker will write on our letterhead. And a lot of agents seem to accept that. If they are engaging as a buyer's agent, we tend to always do a pre-approval, because what we find with buyer's agents is they tend to be able to land a property more quickly and have more options for the client. So it's more likely the deal is going to proceed. And also the other thing we'll do is, if it looks to be a bit more of a complex scenario that we're going to need a lender to sort of maybe approve something a little bit out of policy, or to see the positives enough to put a bit of an argument together, we're going to have to sort of convince the lender that this is a deal that's worth supporting. Well, in those cases, we'll get a pre-approval as well, because it can go either way. But where it's very, very strong, we might just recommend a letter of eligibility. So it just depends. But I think, you definitely need to get some form of approval up front, because the competitors to you in the market, if you don't have it, they probably will, and you probably won't get the property. So I think you need to. Yeah.
And it also gives you the confidence to act when you find the right one. Like I've got a current situation where a buyer, I've got one offer in, I've just texted all the rest of the buyers. One buyer's just messaged me back saying, can I give him another 2 days because he needs to finish off getting his finance checked, and you just don't want to be in that position, do you? So
no, you don't. No, all of a sudden you go, maybe I'll go to the others where they don't need to do that, you know?
Yeah.
Yeah, absolutely.
I'm trying to find out from him, what's his price. So if I know if it's worth waiting, but he's saying he can't tell me his price until it's fully checked. So I'm like, oh, do we wait? Do we move ahead? So
Tricky.
Still deciding on that one.
Yeah, tricky.
Now, for those investors and, well, not necessarily investors, just anyone that owns a property in WA, they would have seen, large increases in the last 2 to 3 years. We probably all wish we could go back and purchase a few more properties and get some more equity that we'd now be sitting on. But people do have a lot more than they even realise. And I'm often blown away when I'm appraising properties because I think, gee, I've still got the 2020 prices in my head, and I'm looking at something in Kenwick at the moment that's a 900K property, and that was just unheard of. It was the lower end, and stuff in lower end properties getting that sort of 800, anywhere from 700 to 900 when they were previously bought for 350 to 400s in the last 3 or 4 years. So people have a lot at that lower end, and thought I'd just go a bit deeper into this, how to leverage your equity and what can you sort of start to look at to see what options you have.
Yeah, so I think, we get a little bit more specific about this, but I think you're right. I mean, it shocks me as well what properties are worth, and even people that have only bought a little while ago, how much equity they've got in their property today. It can be absolutely significant. So the idea being is, I suppose I've talked in the past about different types of debt. So bad debt, good debt, and excellent debt. And good debt is a home, to buy your own home to live in and have a home loan, because what I've seen in the past is people have never been able to save cash to buy a house. So it's good to have that. Excellent debt can be an investment debt because it's tax deductible, you're getting return on it. And it's so much easier to service a loan if it's an investment loan because of the tax deductibility and because of the rent you're receiving. So basically those two things are helping you pay most of that loan repayment back. So when it comes time to use the equity, we look at what your house is worth today. So get a valuation or an appraisal to give us an idea, and what your loan is. And the difference is the equity. And ideally, if we can get another loan which can be used as a deposit to buy your investment property against your home, that's what we would do. And ideally, we would keep the borrowings against the primary place of residence, your home, at no more than 80%. So there's no lender's mortgage insurance to buy there. And depending on how much equity you've got, then depends on how many deposits you've got for another property. So if you've got a lot, you might be able to buy 1, 2, or even 3. If you've got a little, you might only be able to buy 1. So it just depends. But using that equity to borrow money to fund the deposit for the investment property. What that ends up happening is that you have 2 loans on the property. You have the deposit loan secured against your first property, and then you have the investment loan. The ATO always says, what's the purpose of the borrowings? And in that case, the purpose of both those borrowings, the deposit and the loan to buy the property, are both tax deductible. So even though it's secured by your home, it is still tax deductible. And that's what we sort of mean by using that equity. And it may be to generate a 10% deposit or a 15% deposit or even a 20% deposit on the investment property. And then it's a matter of waiting, I suppose, for time as you pay down potentially your home loan, or you save money in an offset account for another deposit, and the equity to go up in the investment property over time. You can also leverage off that investment property to help buy the next one. So you're continually restructuring this to see where you're at as far as an overall equity to get the money out to be able to buy the next property. And that's what investors that end up with large portfolios often do over a period of time, is they build the equity and then they borrow off that equity to help fund the next purchase. Yeah.
Well, it is a great way of leapfrogging into other properties, and you obviously don't have to pay tax on that amount that you're pulling out because you haven't sold anything, which is a big advantage.
Yeah.
And I do like bringing it back to, what's a return on, cash invested. And if you're putting really none of your own money in at that point, you're just using the equity that is in there. You're not having to put up the hard-earned saved cash that you've already paid tax on. That return on investment is almost infinite. Well, there's only so many properties you could buy, and you do need to be very selective at how you use your borrowing capacity. But, if you haven't put any money in and then you've got another asset producing for you, it is an infinite return because you haven't, you haven't put any cash into it. So
And that's right, yeah. And it's interesting. Over the years, what I've noticed is that most people are really good at paying their loans, right? So very few people, if I see, default on their loans unless something terrible happens in their life. So people are really good at paying back their loans, but there's only a few people that are quite good at saving. So I've always thought that with an investment property, that if somebody takes on investment property and they can afford it, I know they're going to make the loan repayment. And I know over time and over a longer time, they're going to end up where they're going to end up significant equity in that investment property. Yet if we left them to their own devices to save the money, they wouldn't save anything. So I always see that as being a real positive with investment properties. Yeah.
Well, it's forced saving, if you will. And most loans, so you're finding most investors start out with an interest-only loan on that investment property while keeping their home principal and interest, and then switch to paying the principal off later, and what sort of terms are typically common?
Yeah. So most loans have a 30-year loan term, and investors historically have obtained a 5-year interest only, which seems to be the maximum you can get with most lenders. And at the end of the 5 years, if you do nothing with that loan, it will convert to principal and interest over the remaining term, which is 25 years. So I suppose the theory with that is that whilst you're paying interest only, the repayments are less when you initially buy this investment property. Because they're less, it means you've got more cash flow to be able to either reduce your non-tax deductible debt or build up your savings again in an offset account. And then in 5 years' time, depending on where the market is and your borrowing capacity, you could potentially look to do that again with a new loan, potentially. Or if you can't, it's going to convert to 25 years principal and interest. There was a time when the interest rate, if you were principal and interest or interest only, was exactly the same. And then after we had the GFC and the issues with the lending in the US, the banks said you needed to have more capital for interest-only loans, so they put the rates up a bit, so they're a bit higher for interest-only. But as time has now gone by, we've seen those margins drop with a lot of lenders. So the difference between interest-only and principal and interest is not as great as it once was. So that's reassuring as well. So again, I think it depends on people's plans, where they're at. If they've got no personal debt, they've paid off their home loan already, and they're quite conservative and they're not looking to build a big investment portfolio, perhaps they just want to buy the one, well, then we might say, look, okay, well, let's get a cheaper interest rate and go principal and interest from day one. If somebody says, look, they've still got their own debt on their own home, they want to pay that off, well, then maybe we go interest only. Or somebody who wants to build a bigger portfolio, again, maybe interest only. So it really just depends on their own circumstances, Jared. But it's something you need to be aware of, and a discussion you should definitely have.
Awesome. And I know with my homes, as I've sort of been still wanting to keep as much parked in offset, I've sometimes switched my actual home loan to interest only to help me save and move forward faster as well. Even though there's that slightly larger, higher interest rate to pay, I prefer to have the money, the flexibility, and have the money so it can apply to your home as well. Yeah,
I think it also depends on the person, right? So, if you're fairly into this and you're fairly disciplined and you're good at budgeting and things like that, having money in the offset is really the way to go. But if you're not, and you're tempted and you buy stuff all the time, maybe reducing the debt is a better policy for you. You've got to know what you own. You've got to be realistic with this stuff. I think the other thing that we haven't talked about is if you buy your first property as a home, and there's a potential that you're going to retain that as an investment for the longer term, well, then you don't want to be smashing that debt down and paying that debt down, because it's going to turn from a good home loan to an excellent investment loan. You definitely need a loan with an investment with an offset account, so you can park all your extra money in the offset account. So then when it comes time to buy property number 2, you've got a large cash deposit to put into your next home. So that's a very important consideration as well. And again, another conversation that you should be having when you're talking about the right structure for your finance.
Well, I guess having an overall sort of plan for where you're going makes your job a lot easier if you know that, one investment property here versus a plan to upgrade your home, add other investment properties, build out a whole portfolio. You can start with the end in mind then and really set things up right from the beginning.
Well, that is the ultimate, because you can really trip yourself up along the way with unintended consequences. You think you're doing the right thing, doing, everything right, and there can be plenty of online stuff that say you're doing the right thing, but it's not specific to you and it's not specific to your circumstances or your plans Everybody has a different potential from earning and things like that as well, which should be taken into account. So yeah, that planning is critical. And we all understand plans can change, but that's going to give us the best shot of getting the structure right for you. It's really going to help you get to where you want to get a lot sooner. Yeah.
Now, finally, I thought we'd just touch on going beyond some of the big banks and their rigid policies. You know, who could this be applicable for, and what are some of the ways it could potentially help someone add that extra property that they thought that they potentially couldn't get?
Yeah, so I think, I mean, it's a bit of a fallacy, the big banks actually, to be honest, because all lenders have slightly different policies, have slightly different products and rates. And what we've certainly found in the last, probably 12, 13 months or something like that a lot of not the big four have had the better pricing in the marketplace. So obviously rate makes a big difference to an investor, but it's not the be all and end all. But there are a lot of alternative lenders who have unique policies that can make a difference. And it depends on people's circumstances. But there's been a fair bit of talk in the media lately, and probably a lot of people have heard about this affordability rate. And that's a rate that's set by ASIC in relation to the lenders, how much of a buffer they've got to have between today's interest rate, what you're borrowing the money at, and an affordability rate that has a buffer on it where they work out the repayments and say, well, look, even though you can quite comfortably afford the repayment today, can you afford them if the interest rates go 3% higher? And that sort of makes sense, right? When you're first home buyers and you've got your home loan. But when you have a sophisticated property investor that's got significant amount of debt, significant amount of different income coming in, they're sort of on that same 3% buffer as well, and it can significantly reduce how much you can borrow. But not all lenders, funny enough, have to comply with this ASIC rule. It's only certain lenders that ASIC put this on. So there's other lenders that we have access to that have 1 and 2% buffers, and that can make a significant difference. So we're not talking really much higher interest rates, just maybe slightly higher than the best deals you can get out there, but they have a buffer of 2%. They'll also do things like take 95% of rental income, whilst a lot of lenders only take 80% of rental income. They'll use full negative gearing benefits. So they'll look at a client's income and saying, well, this is their portfolio, this is their debt load. They'll be getting negative gearing for that. So they'll take allowances for that. So what it means is some of these lenders can have a borrowing capacity significantly more for an investor than what, say, the mainstream lenders and second-tier lenders that don't have those same policies can achieve. And then the other thing is it sometimes depends on, I mean, in West Australia, we have a lot of mining people, and some of those miners can get their base salary, plus they'll get shift allowances and site allowances and travel on their break day as well, depending on when they fly in and fly out. So all these allowances can add a significant increase to their income. Well, some of the lenders don't get that, so they'll discount that. They'll say, oh, we'll take 80% of all those loadings. Yet it's the same every single fortnight. Every day it's the same. Doesn't matter if they're on site or off site. It's exactly the same. On holidays, off holidays, exactly the same. But some lenders will take 100%. So that can make a big difference to those people. The last thing I'd just like to say in relation to this is self-employed. So self-employed has always been very conservative in the way and very set in the way that they assess income. And the lenders have now changed that significantly. So there's lots of different options how a self-employed person can now have their income assessed. They can pay themselves salaries and be assessed the same as their employees are. And there's different ways of looking at those salaries and different time frames you need to do it. So if you are self-employed and you're finding it complex to be able to get income, to get loans, and they want a lot of information and you just want a simple solution, having a chat to your broker early on, we might be able to give you some advice and say, well, look, you can pay yourself this salary if that's suitable. You go into the PAYG system and you can be treated the same as any other employee. And then you don't have to show all your financials and tax returns and da-da-da-da-da. It's just more simple documentation. And for some people, that can be really, really beneficial to them. So, yeah.
Great. And with this sort of extra lending, are you seeing anyone yet doing any developments or developing existing properties? Is that even started to turn for you yet. I haven't really seen it from our clients and the properties we manage yet. So I'm always just keen to get your take as to whether you're seeing any yet.
I'm just trying to think if we've seen anything. I don't think we have, Jared. I don't think I've seen any development funding of late. I've had a few clients talk about it. You know, it's that big uncertainty, I think, of the build time frame and also the build cost. And from what I'm hearing, and again, this is not my area of expertise, but it's difficult to get the numbers to stack up.
Yeah.
When you look at what the build cost is potentially and what the end sale cost is, and particularly how much the properties are selling for and over the odds at the moment, sort of people say, well, I might as well just sell it as it is. And I don't know, you probably know this, if people are paying much of a margin for development sites at the moment. In the past, people pay quite a margin. I've had clients buying investment properties and I haven't seen any issues with the valuations coming back at contract price, even after a full valuation. Whilst in the past, they might have come back a bit less because they said, the clients were paying for a development potential, but they don't seem to be doing that in this market. It just seems to be going on market sales evidence.
Yeah, I think there's enough. There is certainly people purchasing the sites and stashing them away, but I haven't had anyone that I'm aware of, and this is crazy when we've got so many people that we manage for, and so many. I haven't had anyone that I'm aware of actually seeing it attractive enough to move forward at the moment on. So, and
that's an issue, right? For everybody's saying we've got this housing shortage, and it sort of makes me think part of the reason why the market's going to stay up, because it's for big and small developers, it just doesn't work at the moment to provide this extra infill, extra properties that we all need. So I think housing is going to remain short.
Especially when interest rates are higher. If you have to demolish your house and lose your rental income, and you've got to offset these higher interest rates as well, that's a much greater, the holding cost is far greater than ever it used to be. And then I did a recent episode where I looked at, is the building bottleneck crisis any closer to being solved? And the actual cost to build has gone up so substantially too. I was hoping the gap had narrowed, but it's actually widened on established properties. So established, it just means have a much further to go until building becomes more attractive. And it seems our state government is doing a lot of things, at least in the media, to try to move the needle, but not seeing it yet in terms of price and time periods as far as I can see.
Yeah, and I think there's a shortage now of building, right? So we've had a lot of builders fail and go, and we've had a lot of the tradespeople move on. So there's a shortage. So then if you're a builder as well, doing development work and stuff like that's more complex and more difficult. And you say, well, we're turning away people for standalone stuff. So why would we even want to do that? So they're not going to discount it. If anything, they're going to put a margin on it. So that makes it worse. But I think on the flip side of that is, if you're not having to pay a premium for a development site at the moment, and so for land banking, the rents are pretty good. To be able to buy a property today as an investment property that's got potential to develop down the track, because things always change. But at some stage it will work. It's fairly attractive because you're not paying a big premium for these development sites in today's market.
No. And the other sort of backdrop that gives me confidence to all of this is when you've spoken about paying a slight premium to get access to more funding or to get into the market sooner. I think if we can do that now, and it's still affordable now based on the current interest rates, well, we'd have to think that rates will eventually decrease, and that's, the prevailing sentiment and predictions, but exactly when it might happen. What's your latest take on when we might see that?
Well, I think, there's a lot of talk about interest rates being high. I would argue they're not that high. If you sort of look at historically where rates have been, we're probably at a more sort of historic level they've been over recent decades. Low sixes for a home loan, sort of 6.5 for investment. It's really not that high, but obviously we're coming off a sort of a 2% home loan base, so then it seems high, but that was abnormal.
Are any of your clients still on the 2%? Because I just chatted to one the other day that had the joy of locking in a 5-year loan, and he was saying, next year it's coming off. I'm like, oh, you poor bugger, you have to join the rest of us paying normal interest rates. So
well, that's sort of the conversation I've been having with my clients too, exactly verbatim. But Yeah, I've still got some at 199, if you can believe that. I think
Wow.
it's fixed for 4 years, and they're coming off at the moment, so it's a massive jump up. But I never fixed my loan, so that's how good I am at this stuff. But I wanted the flexibility. But yeah, we've certainly got some people still coming off those rates. I think but to answer your question is, the economists are sort of saying later next year is what it's more likely for interest rates to come down. There's a bit of uncertainty with the US and potential tariffs and stuff like that, and what that might do to inflation. Who knows? The world seems to be in a bit of change at the moment. So let's see where it settles. Yeah, but hopefully.
I guess don't count on it, and I just look at it as a bonus and sort of look at that total loan amount and think, gee, wouldn't it be nice to have a bit less to pay? But I think that'll also kick a whole bunch of people that are sitting on the sidelines, that are waiting, and that would be otherwise, more active into doing stuff. So you want to kind of get in before they do.
Yeah, absolutely. I agree with that. And I think, all the economists are saying next year, early to mid next year, we should start to see some interest rate reductions. And there's, some people who are really battling at the moment. The biggest thing I'm seeing with property investment is you've really got to work on your income. How can you increase your income? Loans are bigger. Cost of living is high, as we all know. So if you want to buy an investment property, it's like, well, how do I generate an income where not only do I qualify for the loan, but I can still live and have a good life? Not many people these days want to sort of live in absolute poverty to be able to have an investment portfolio. They want to have a decent life and invest for the future. So it's really important, more so than ever, to work out how you can get yourself into a position where you can earn some reasonable income, because it is, and I hate to say it, but it is becoming, the haves and the have-nots. You've got to improve yourself on all levels if you want to participate in the potential to make some of this money. And you've got to be able to qualify for the loans, and qualification comes back to income to a degree. Yeah.
Well, that's some good advice there as well. So I guess if people aren't sure where to begin, what do you reckon's the first step? I know you help a lot of our clients already, so.
Yeah, I think, reach out to whoever you trust in the finance world. I think you do need somebody on the inside. I think it is a mistake, for reasons we've spoken about today, just to go direct to a lender or to try and do it online. It is complicated. There's lots of different factors. And I think sitting down with somebody who's interested in this investment space, who understands the investment space and can help you understand perhaps what you need to do to be in a position, or what the options. So, and when you pull the trigger, it's very important that we execute that structure of the loan, and the setup is so critical to give you the best outcome in the longer term. Yeah. So I think, reach out to whoever you deal with. You'll need to get some information in these days. We all need the information, but get some information, and then we can sit down and have a meeting and just sort of explain how it all works as far as your borrowing capacity, what it would look like, what the repayments would look like. You can then do your research in relation to the property and work out what it's going to cost you out of your cash flow, what your tax benefits are perhaps going to be. And it's often surprising when you've done all that, how little the actual holding cost is over the longer term.
That's why people, I think, when I'm creating plans for people, they often don't realize, what's the after-tax position of holding a property. So it's a lot more affordable than they appreciated. And the difference between, say, using the same amount to upgrade their house, people always underestimate how difficult it is to do that house upgrade, and just having the full amount of principal and interest in most cases to pay, versus having a tenant over here to help pay the same amount of asset that you're controlling as an investment. So I think if you, it all just gets back to having a clear plan and working with the right people, and that can make it a lot easier. So
yeah, it's interesting, Jody, you say that. Everybody's circumstances are different, and everybody's numbers are different, but very, very roughly, if you had a $200,000 home loan on your principal price of residence, the cost of that loan would be similar of having about $1 million worth of investment loans out of your cash flow each month. So And the reason for that, of course, is the tax deductibility and the return through the rental is helping you pay that investment loan, whilst you're just the person paying your home loan. So I think sometimes people look at people and go, man, we're struggling. Like,
how's that even possible? We can't afford 200K. Yeah,
we're battling to pay our home loan, and yet we've got friends that own a couple of investment properties, and they just dismiss that and say, well, I just can't even understand how that can be possible. And that's the reason. And it's about getting the structure of that home loan. And you might have had that home loan for a long period of time, pushing that back over 30 years now to reduce the repayment, doing an investment loan on interest only initially. You'd be surprised that maybe you can do it, and it's not that expensive for you to do it. But anyway, yeah, it's worth having the conversation. Yeah.
And I think people also do need to be a bit more selective on their property purchases now. Like previously, we could throw darts at a board, and I think that's why the overall plan needs to be really thought out and to see as to, can you afford that higher property, or do you go, more lower and get into some segments that haven't had as much growth as others? But if you're going into the middle to upper end, that market's certainly a lot more undervalued. But if you're more down towards the lower end of your budget, then you need to be ultra selective and really consider, what potential upside there is, because we'll start to get to a peak in some areas, and there won't be as much growth, and it can be a little more dangerous to get in at that time, especially if you're pushing your loan to value ratios and, getting in, right when it might be nearing its peak. So that's why that plan and that research is also very important, especially when we couple that with what you're doing on the finance side.
Yeah, I think so. I think, everybody's strategy is different, and some people start really young, but most people, their first foray is buying their own home. And then if they're looking to buy an investment, often a number of years have gone by, right? So they're not that young when they buy their first investment. And if they're going to be looking to retiring in their 60s, if they're in their 40s when they buy their first investment, it may be 25-year term. So you can't afford to get the wrong property where it doesn't move for 10 years, So, and as they say, you make your money on property often when you purchase the property, right? So, and you don't know what you don't know. So I think getting that advice from people that don't have a conflict of interest, they're going to providing you with impartial advice based on your situation, working with you to what you can achieve to try and have the best possible chance of making a success of this is really the smartest way to go. Yeah, for sure.
Well, thanks for your time today, Nick. I'll pop your details in the show notes so that people can reach out. I know we've got a busy period heading up to Christmas. We've probably got, 3 or 4 weeks before, 3 weeks really, before everything slows down and shuts down. So we're just trying to get all of our ducks in a row and make purchases for those that we're looking for. And for those that, are thinking that, they've got through this year, they haven't done anything with property. They've been meaning to. Now might be a good time to just get set up before Christmas and get your ducks lined up to come out of the blocks early January and be ready for then. So
absolutely.
We use this as a good time to do that before we hit Christmas.
Yeah, absolutely. And I think I was speaking to some clients today about actually trying to get out there now and look, because people are extremely busy, and a lot of people now are sort of saying, I'll do this next year. So people that already have their finances set up, ready to go, there are properties on the market. I think there's going to be less people out and about because everybody's busy with catch-ups and social arrangements, stuff like that. You may be in a more unique position to actually secure a property with less competition in the lead up to Christmas even. So,
definitely.
So
I'm finding that a lot of my properties that I've got listed, I've got 14 odd, and I was expecting a lot of these to have come to market earlier in November, and I'm still making preparations, still planning them to come to market. So I think other agents that I chat to in my basketball team as well have said that they're in a similar boat. It's almost like everyone's just a little, I don't know, summer seems late to go this year. Like the hot weather, we only had our first 34-degree day on the weekend. Maybe all of this is connected, activity, weather, people being ready, people joining the market. So I think as well, if you are around in Perth, keep your eye on the market, keep your alerts set, and there'll be more agents bringing stuff on when the market's tight. People, used to rest and not bring on over Christmas, but now more of us are keen to put it on, especially if there's nothing else on. Keep your eye out, because you might just find that one that you're looking for.
Yeah, exactly. All right.
All right, mate. Thanks for the chat.
Thanks.
Speak
soon.
Thanks,
Joe. Bye-bye.